My name is Dr. Sharat Khandaka, and today I'm going to discuss about the overview of the financial system. Now, when we're going to discuss about the overview of the financial system, we need to understand what are the roles of the financial system. So the financial system consists of financial markets, institutions, and money. So these are the three major themes of the financial system. So the role of the financial system includes facilitate the flow of funds, to provide the mechanism to settle transactions, to generate and disseminate information, to provide the means to transfer and manage risk, and to provide ways to dealing with incentive problems. So these are the basic role. Now, to understand the role of the financial system, we need to understand the flow of funds. Now, the flow of funds includes two basic things. One, the supplier of the funds, and the second is the demander of the fund. So if you look at this side is the supplier of the fund, and on the right hand side we have the demander of the fund. Now, if you can look that the supplier of the fund includes the household, business, and governments. On the other hand, the demanders of the funds also includes household, government, and the business sector. In the middle, there is a financial market, or this is the financial market. So the supplier of the fund to take the funds to the financial market, and the financial market facilitate the flow of the fund to the demander of the fund, and then the demander of the fund, that could also be the household, business, and the government. They supply the financial instruments in the market. So in the market, the financial instrument actually been issued, and then this instrument passes to the supplier of the fund. So remember, every financial system there is always suppliers and the demanders of the fund. However, generally households are always the supplier of the fund, though sometimes they can be the demander. For example, if you want to buy a house, and generally people buy a house through the mortgage. So you go to the bank, you borrow money, so you become the demander of the fund. But generally the household, because they want to save for the future, they are the supplier of the fund. So the same thing can happen for the government and for the rest of the world, or even the business sector. So the economics unit can be classified as the household, business, and governments. So a supplier unit is a unit whose income exceeded the planned expenditure. For example, if you earn $5,000 a month and your expenditure is about $4,000 a month, so you have about $1,000 surplus. So this surplus, of course, you do not want to put just in your locker. So you want to put in somewhere. It will create, or it will generate some more money so that it can give you some return. On the other hand, a deficit unit is a unit whose expenditure exceed its receipts. So for example, you can look at the governments. Most of the governments nowadays, they are the deficit unit because they want to borrow money. They want different ways to borrow money. That's why the government implement taxes. The government implement income tax. The government implement VAT. The government implement land tax. There are so many tax systems. And on the top of that, even the government issues different types of security in the market in order that they can borrow more money. So the flow of funds from SSU, mainly the household, to the DSU, mainly the business firms and the government, is the fundamental functions of the financial system. Now, when we are discussing about the financial system, you also need to understand what is called the direct financing and what is called the indirect financing. By the name, you would be able to understand the direct financing, where there is a relationship between the supplier of the fund and the demander of the fund. So there is a direct relationship. So if you look here, it stated that SSU lent money to DSUs and accept a financial claim in return. In direct financing, this exchange takes place directly without any intermediary or without any financial institutions. The limitations of the direct financing creates a role for financial intermediaries to intervene between DSU and SSU. So, if you're thinking about the direct finance, the example could be IPO. So, it's directly selling to the public. On the other hand, when we're thinking about the indirect financing, so in direct financing, there is an intermediary. So, in the direct financing, it requires DSU to find SSUs that want direct claim, and demonstration involved are usually very large. However, this problem are resolved through the involvement of the financial intermediaries, such as the banks, such as financial institutions. So financial intermediaries purchases direct claims from the DSU, such as the household, government, and the business sector, transform them into an indirect claims, and then sell them to the SSU. So if you go to the bank, you can have different types of product, and those types of product also have different types of maturity, even the different types of liquidity. So depending upon the customer demand, the financial intermediaries transform or modify the product. So what are the benefits of intermediation? So when intermediaries transform their direct claims into an indirect one, they perform 5 services. Number 1 is denomination diversibility. The second is currency transformation. Number 3 is maturity flexibility. Number 4 is credit risk diversification. And the last one is the liquidity. So look each of them and try to understand why these benefits are from the financial intermediary. For example, liquidity. Depending upon the customer demand, the financial intermediaries can design the product in various types of liquidity. For example, if you want to buy a car, you can get a car loan that is for 5 years. On the other hand, if you want to take a house loan or mortgage, that could be for 25 years to 30 years, or even could be only 20 to 25 years. Credit risk diversification is also a benefit for the financial intermediation. Maturity flexibility, because the product the financial intermediary offers, it has different types of maturity from couple of months to long term. Currency transformation, it can borrow money from different currency, but that it can transform to a local currency. So this is a great benefit for its customer, and they can get actually in cheaper price the product. And the denomination diversibility, which is another very big advantage for the financial intermediation. So in the market, we can see there are different types of financial intermediaries. In Australia, the financial intermediaries that can include: number 1, banks, building society, and credit union. Number 2, foreign banks representatives. Number 3, general and life insurances. Number 4, friendly societies. Number 5, money market corporations, finance companies, and securities. Number 6, licensed trustees. And number 7 is superannuation entities. So in this chart, we can see the Australian financial intermediaries, the number of them, and the total asset in $1 billion. If you look the first line, you will find the authorized deposit taking institution, or ADIs. There are 177 in Australia, and the total asset size is $2,813.4 billion. Remember, this data is about 2 to 3 years old, so it's not showing the correct reflection or the current asset value of these financial institutions. However, if you look at the banks, there are about 56 banks, and out of these 56 banks, their asset size is $2,722.9 billion. If you look further, you'll find there are 4 big banks in Australia, which are the Commonwealth Bank, the National Australian Bank, the Westpac, and ANZ banks. And these 4 big banks' total asset size is more than $2.75 trillion. So these 4 banks are actually representing more than 90% of the total asset size of the banks. The same way, the building societies, there are about 10 building societies in Australia, but their asset size is not very big. However, if you look into the other institutions, you will find the life insurance companies. There are about 31 life insurance companies in Australia, and their asset size is about $235 billion. If you go to the next slide, it's showing the growth of financial intermediaries. Now, you'll find something very interesting. In the left hand side, these are the years. So the years start from 1990 and it's end in 2011. The next column is showing the RBA and the banks. So around 1990s, the total size of the bank balance sheet, or the total asset size of the bank balance sheet, was $348 billion. Just after 20 years, you would find the asset size of the bank increase by more than around 8 to 9 times. So in 2011, the total asset size is about $2,729 billion, which is about $2.7 trillion. If you look into the other institutions, such as building societies, their asset size is not growing at all. The next one is the credit union. At 1990s, the total asset size of credit union was about $8.7 billion, which is now about $55 billion. Money market corporations, the asset size in 1990s was $48.5 billion. In 2011, it's $66.7 billion. So if you look at this institution, you will find the bank did extremely well. However, there is another institution that did extremely well during this economic situation, and that is the Superannuation Fund. If you look into the Superannuation Fund, in 1990s, the total asset size was about only $81 billion. However, in 2011, it became $962.8 billion. Now, there is a huge change in their asset size, and it grew more than 10 times. So, in Australia, only 2 institutions are doing extremely well, and they became extremely profitable. So, which are number 1 is the bank, and the second one is the superannuation. So let's talk about bank. So the commercial bank are the largest and most diversified intermediaries. Australian-owned commercial bank, they hold more than $2.9 trillion in their financial asset by the end of 2014, which is about 200% of the GDP. This asset consists of loan to the consumers, businesses, and the government. And the commercial bank's liability consists of deposit accounts and other sources of funds. Further, commercial bank might also be engaged in other activities such as underwriting. So in the previous slide or this slide, the banks what we're discussing about in here, these are the commercial bank, and they are the most powerful institution in Australia. So if you look into this slide, it's about Australian owned bank and their asset size. And you can look, the Commonwealth Bank of Australia, the total asset size is about 23.92% of the total banks in Australia. ANZ Bank, the total asset size is about 17.29% in all banking sectors in Australia, and National Australian Bank, their asset size is about 20.4% in out of all Australian banks. However, when we're discussing about the banks and the depository institution, we also need to understand there are some institutions which are classified as non-bank financial corporations, or we can also call them NBFCs. NBFCs provide many of the same services and products that the commercial bank provide. NBFCs may also be classified into 4 groups. Number 1 is the building society. Number 2 is the credit union. Number 3 is the money market corporations. And number 4 is financial companies. Other financial institutions. There are several other financial institutions that operate in the financial system, which includes the life insurance companies, general insurance companies, superannuation funds, managed funds, and securities. Now we'll talk about some of the international organizations that can also impact in Australian economy. Now this international organization includes the Bank of International Settlement, or BIS, the World Bank, the International Monetary Fund, and the Asian Development Bank. So these banks are very important for us. For example, the Bank of International Settlement is treated as the bank of all commercial banks. The World Bank, they give advisory services to different countries of the world. The International Monetary Fund, looking after the monetary policy of international. The International Monetary Fund is looking after the monetary policy of different countries, and the Asian Development Bank is for the Asian countries, and they can provide the loan to the Asian countries, and those loans are quite reasonable in terms of interest rate. So the next slide is talking about the primary market and the secondary market. The primary markets are where the financial claims are initially sold by the DSUs or the demander of the fund. This might take the place through an initial public offering of shares to the public. On the other hand, the secondary market are where the previously issued financial claims are exchanged among the investors. So in the secondary market, there are no new issues are traded, but only those shares which are already listed are traded, and the exchange rate and exchange taking place between the investor and the investor. So when we're talking about the primary market and the secondary market, we also need to understand about the organized and over-the-counter markets. Once issued, the exchange of claim can be placed on an organized exchange. In Australia, for an example, the Australian Stock Exchange is an organized market. On the other hand, the financial claim can also be exchanged in over-the-counter, or which is called OTC. OTC market have no central location or the physical location, and it can be taken place in anywhere in company boardroom to the company trading floor. Other markets. There are different types of other financial markets which we can see, which includes the future market, the option market, foreign exchange markets, international markets. For example, the euro currency market and the eurobond markets, where the domestic or overseas firm can borrow or lend Australian dollar deposited in overseas banks. money markets. Now when we're talking about the secondary market, when we're talking about the primary market, we also need to understand what is money market. Money market is those types of market which is a wholesale market. It's a wholesale short-term market where securities are traded less than 12 months and claim is classified as a money market transaction. So in the money market where only the certain types of financial claims are traded which are below 12 months or 1 year. So in the money market, banks and businesses adjust their liquidity position by borrowing and lending for the short time on the money market. The government bank, RBA, has also conducted monetary policy in the money market, and their main target in the money market for the RBA is to control the monetary policy and adjust or fine-tune the monetary policy whenever it's required. The money market consists of the collection of markets and each trading in different financial instruments. All of these instruments have characteristics are very similar to the money market, and most of the money market securities are highly liquid and low in default risk. Now in the money market, there are different instruments that are traded in the money market, which includes the treasury note, commercial paper, commercial bills, negotiable certificate of deposit, which is also called CD or NCD, secured and unsecured note. Now remember, as the money market is a short-term market and instruments are traded for below 12 months, so all of these instruments are having a maturity below 12 months. On the other hand, the capital markets, where the longer term securities are traded, and generally it is more than 12 months. On the capital markets, capital goods are financed with the stock or longer term debt instruments, and capital market instruments are less marketable, having varying default levels and have maturities ranging for 5 to 13 years. And the instruments that are issued in the capital market, which includes shares, and the shares include the ordinary share and the preference share, government or corporate bonds, and mortgage instruments. However, there are several risks which can be faced by the financial institution in the money and the capital market. Financial institutions are exposed to variety of risk, which includes credit risk, interest rate risk, liquidity risk, foreign exchange risk, political risk, reputational risk, and environmental risk. All of these are faced by the financial institution. Therefore, each of the financial institutions need to be carefully managed all this risk. So, when we're talking about managing the risk faced by financial institution is managed by different ways. Number one is the diversification on loan and investment. So the diversification is always an important factor for the financial institution. So they need to make sure their portfolios and investment loans are diversified. Number two is the careful credit analysis of the borrower. So when they will be giving the loan, they need to make sure that they have a good credit rating. Number C is careful monitoring of borrower over the time. So after giving the loan, so it's not that they've given the loan and they'll forget about it. They need to carefully monitor the borrower over the time. And number D is to undertake an appropriate hedging strategies on the financial market. That's all for today. Thank you for watching this video.